20 to 80% equity to bond ratio is the lowest risk profile because of potentially loss in purchasing power. But trying to convince a client of some Nobel Prize winning economic data and what their intuition says are two different things. But if I can come to them and say, I have this structured product that gives you equity exposure with no risk, you might lose potential income of 1%, but with the possible gain of 10% a year, would you be willing to take that risk? And they're like, well, as long as I'm not losing money, I'll take that risk. And then I can give them the 20% equity exposure that they so desperately need to keep them up with their purchasing power. So that's where I started with this. But then as you started looking deeper and deeper into some of these structured products, we have kind of decided across the board, at least our firm, to allocate at least 10 to 20% of our clients' portfolios to structured products, because some are extremely risk averse, and there are some that can be a little bit more risky, like perhaps the Tesla product, which will still give you 20% returns, but you have some dependence on a more volatile stock. So we're treating it almost as another asset class because the correlations are very low to the S&P 500, and the volatility tends to be low. So it actually reduces your risk of a client's portfolio. So who could use it? Really, anybody can use it as long as they can get their head around the analytics and get comfortable with it. You want to be comfortable with the investment.
That's a good statement. Let me ask this question then. What would be the bottom dollar to get into a product like that? And the reason I asked this question, because I know there are other financial advisors listening, and I did used to work for JP Morgan, so you're talking about my old firm. But there are people that don't work for firms like JP Morgan. They work for firms where they don't understand a structured product and don't have the exposure to it, but may have the potential if their compliance officer can get their head around it. What would we be at?
So the minimums are $1,000. You can buy one structured note for $1,000. Now, generally, you have to go what's called on calendar, which means JP Morgan, Citibank, Goldman will put out a list of structured notes, and there'll be dozens of them that they'll put out every month. And they'll say, these are what we're offering, because it costs money to put these things together every single month. They'll say, these are what we're offering, but you can buy in $1,000 increments. Now, we created the Tesla note and we created that other S&P note, in which case we would need probably somewhere in the neighborhood of $200,000 to create a note for our particular clients on the fly, depending on market conditions. But to get $200,000 worth of exposure across all our clients, it's not that hard. So if you're a retail investor and you actually have a JP Morgan or Chase bank account, it's quite likely that their local representative in the bank won't be able to sell you those products. They're more institutional level. So you might actually have to go through an advisor to get them.
Okay, very good. So you need more than one financial advisor then to do that. I just want to know that, because your diversification in your portfolio is not limited to just the advisor. You need to look beyond that.
Right.